How do we raise more money into a fund? We did one video on capital calls, which is a mandatory situation where you find yourself in a little bit of trouble and the investors have to bail you out. That's one thing. But what if you just want to grow your fund? What if you have a fund that's doing very well? You raise a couple $1 million in the beginning and you say, gee, we're doing very well. Let's go get some more. That's a different situation. That's not a capital call. That's just growth. And growth is a very good thing, especially in a fund. In a syndication where it's a project, you might just do one project. There really isn't a lot of need to build in provisions that would allow you to add more capital, because the purpose of the fund, of the syndication, is to buy that one unit, one building, apartment building, whatever it's going to be, fix it, organize it, operate it, whatever you're going to do, not to go buy a whole bunch more. If you want to buy more, you're probably using a fund structure. And a fund structure is designed for expansion and growth, kind of an accordion style deal. So here's what happens. You build into your operating agreement the ability to go back to the investors and say, look, we're going to we did one $5 million round, we filled it up, and we've been operating on $5 million so far, but we want to go do another $5 million round. So you give the investors the first right of refusal. You say, would you like to have the opportunity to put in more money? So you own, let's say the person put in 100 grand, they own 2% of the 5 million, let's just say. You can, by the terms of this agreement, you can put in another 100 grand to keep your percentage of ownership and your percentage of profit sharing the same as it is right now. The person can say yes or no. There's no penalty, and there's no extra benefit. If they want to do that, they can. If they don't want to, they don't have to. Now, after all the people have been offered, you can go back to people who say, listen, by the way, if there's more, I'd like to even put in more. So as soon as people say, I'm not going to participate any further, then you can go back to people and you can say, you can sell them more shares as if they're brand new investors. You can also go to brand new investors and you can take new people. Now, the issues with raising more money at some point in the near future work like this. First, what's the price? If the first people came in, let's say at $25,000 a share, what's a reasonable or appropriate price for people to come in a year or two later now that there are some assets in the fund? Well, it depends on the kinds of assets. If they're turning over, so you buy something, you sell it, you take profit, distribute the profit, then really the share value has not really gone up because there hasn't been any appreciation. And it might be reasonable or okay to sell the shares for the same price. Even though common sense says that the price should go higher, it isn't necessarily necessary. But let's say you buy an apartment building and that building has gone up 15 or 20% in the last year or two since you originally raised the money. Now you're going to go raise some more. Well, then you really have to raise the price, because otherwise the people who come in second would get the same exact deal as the people who came in initially who took more risk, and that would not be fair. So you want to make sure that you're properly appraising and evaluating your assets to make sure that things are reasonable, so that the next people come in at some kind of a bump that recognizes what the first people did. So now, you got, let's say $5 million comes in for the first portion, and then you've got now you're raising another $5 million, but they're not going to get exactly the same. They're going to get a little bit less, and that way the people who have gone in first are going to get a little bit better deal than the people who came in second. And for profit sharing and ownership and voting and other kinds of things, it's entirely fair that it worked that way. So it's very important that you structure the ability to expand your deal. You want to give a first right of refusal to your first people. But other than that, it's entirely reasonable that you could grow your fund. Now, what is it called, each of these different arrangements? They're called rounds, funding rounds. And think about this like a golf tournament. A golf tournament has 4 rounds. Each round stands on its own, but in aggregate, now you've got a 4-game golf tournament. And that's really the way that funds work, is that there's a funding round. So the first round might be 5 million, and then you say, okay, now we want to do another round inside the same fund. You don't have to set up a whole new fund. You don't have to set up a whole new tax structure. You don't have to do new tax returns, new financial statements. It's inside of the same deal. They're kept track of a little bit separately, and there's a little bit of accounting or bookkeeping that has to be done to make sure that it's done just right. But for the most part, it's very simple to bolt on another round and grow your fund that way. So you can have a second round, a third round, a fourth round. You just have to be careful about how you're allocating profits and how you're allocating especially unrealized profits, those profits from assets where there have been some escalation in value, but that hasn't been actually taken and accounted for and distributed back to the investors. So once you figure these things out, a little bit of technical stuff, sometimes an accountant or somebody has to be involved to figure this out, but it's really not terribly complicated, and it gives you the ability to grow your fund the way that you want, give you lots and lots of control in a very fair and reasonable way. And that's what makes this such a great business. So go out and stake your claim.